This is a pretty important lecture. Builds on what we talked about on Tuesday with money, the history of money, a little bit of information about the banking system. Here we're going to take it to the next level, talk about our banking system and the money supply in our banking system, in our economy. And this really all builds up to monetary theory and policy, which I believe we will cover on Tuesday of next week. It's big. So this all builds on that. It's all really important stuff. So chapter 28, banking and the money supply. The first thing we're going to talk about is how we measure money in our economy, or really any economy. And we call these money aggregates. An aggregate, we've talked about the word aggregate before. It's just really a sum of something. We're summing something up. It's just, there's a couple of different ways that we add or sum money and come up with these money aggregates. There's really two definitions, if you will, of money, and we refer to them as M1 and M2. M1, we're just talking about adding up money, different sums of money, different ways to calculate the amount of money in the economy. M1, much, much smaller than M2. Those are the two money aggregates we're going to talk about. M1 is essentially really, really liquid money. It's very easily accessible money in the economy. It's the most narrow definition of money that we have, so this is going to be a much smaller number than the second aggregate, which we're going to talk about. M1, it's basically physical cash money, so the money you have in your wallet would be considered part of the M1 total. It would also be checkable deposits. That's your checking account. Anytime I say checkable deposits, those are deposits in a bank that you can then write checks on. We don't really write checks same way that we used to. So this is the money that you access with your debit card, checkable deposit. It's very liquid. It moves very quickly. When you swipe that debit card, that money goes from one account to another very quickly. And traveler's checks, very, very antiquated. I don't even know if anybody issues traveler's checks anymore. This used to be a little piece of paper that people used to take cash to a bank or get money out of the bank and turn it into something called a traveler's check, which was essentially a little piece of paper that you traveled with that was as good as cash. The one upside to it is if you kept track of the numbers and things on these traveler's checks, on these pieces of paper, if you lost them when you were traveling, they could essentially be canceled and replaced. We don't really do that anymore. I don't even know if you can get a traveler's check if you want one, but it's in your textbook, so I thought we would talk about it. It's giving you a little definition of checkable deposits here in case there's any question. It's what you access with your debit card and your ATM card. So if we were to add up all of that money, the cash sort of in circulation out in the public and what was in your checking account, we would come up with what we call M1, the M1 calculation. M2 is quite a bit bigger. M2 is everything in M1 plus. So it's the cash we just talked about, it's the checkable deposit, plus it's other near monies, if you will. So it's other near liquid monies, other things that you could access fairly quickly that you can't access nearly as quick as $1 in your pocket or a swipe of your debit card, but darn near as quick, okay? Just moves a little bit slower. And we don't spend it quite in the same way that we would spend money in M1. M1 is quick moving money. M2 is that quick moving money plus other stuff. So that other stuff is things like your savings. Most of the time, we don't move money in and out of our savings the way we move it in and out of our checking accounts. Time deposits, here we're talking about like CDs. It's an investment product, a certificate of deposit. Money market mutual fund accounts. Again, this is an investment account that you many times can write like checks against or out of. So you invest money with a bank, usually in what's called money market mutual funds or money market funds. And you're able then, if you need to get money out, like it earns interest for you, but if you need to get money out, you can just write a check or something like that. So pretty quick and easy. Let's see, savings deposit just gives you a little bit more information about savings deposits. Sorry. Sorry, I don't know what's happening to the screen. Give me just a sec. Okay. Okay, just gives you some definitions of what a time deposit is, how we would define a savings deposit, and money market mutual funds. You do need to know a little bit of something about these. The most important thing you can know about M1 and M2 is that M2 is bigger than M1. That's the most important thing you can know. And that M1 money moves fast. M2 money doesn't move as fast because it's M1 plus all these other slower moving monies, if you will, or near monies. Okay, so you can see her on the screen, and this is for 2012, so this is out of your book. But you can see these numbers aren't important in terms of billions of dollars or anything like that. That's not important at all. What's important is sort of for you to look and make a comparison between M1 and M2. M2, much, much, much larger than M1. M1 is a fraction of the money in the total banking system. I probably don't even need to bring this up. It's in the chapter. I thought in case anybody was confused about this at all, it's an important thing to understand. The difference between debit cards and credit cards. Like I said, I bet 100% of you know this. The debit card accesses money you already have that you've deposited as a checkable deposit, and credit cards is essentially you borrowing someone else's money. Okay, so let's talk about how banks make money, how banks work, and how banks affect the money supply. This is really interesting, I think, for most people. I don't think most people really understand the way that money is multiplied in our banking system. We have a banking system that's essentially built on money that doesn't exist, which should be a little scary to most of us, but it's the way the system is designed. It's kind of too late to change the system. Essentially, what banks do, the way banks make money, is they attract your deposits. Why do we put any money into a checking account or a savings account? Well, probably the first reason is to keep it safe, if you will. If you have sizable amounts of money and you don't want to carry thousands of dollars around in cash or whatever, it's just a good place to, for safekeeping. The other thing is it allows us to use those banking tools that we appreciate, like things like, debit cards or whatever. But you and I deposit money. It's a safe place. It's a good money management tool because we can use the debit cards with that money. And we get a very, very, very small amount of interest paid to us. It is not the interest paid that should be attracting you to a bank. Banks do not pay you enough interest to put money in the bank. We're attracted to banks, I think, or we should be attracted to banks by the use of those money management tools. And so we're not carrying thousands of dollars around in our pocket. And that's really not a safe way to go either. So banks attract us to put our money in the bank. We already know they don't need to keep much of it actually in the bank. So they can lend it out. It is in that lending that banks make money. So banks take your money, don't pay you very much, lend it out, charge a whole lot more to those people who want to borrow it. And it's how they make money. People that are willing to pay interest in order to borrow those dollars. Banks as financial intermediaries. We've already talked about how banks are financial intermediaries. Intermediaries, they are a go-between between people that have money to lend and people that want to borrow money. An intermediary, somebody in between, sort of that middleman, if you will. There are a couple good reasons why banks make good financial intermediaries. If I have money to lend out, it's pretty risky for me to just go try and find somebody on my own I think is worthy of the credit, is worthy of my money. Banks are a really efficient way in our system to provide a channel between people who have extra money and people who want to borrow money. And they really take the risk out of being a single individual who has money to loan out. Granted, we don't make very much. This is not a good investment tool, but it sort of is a consequence of us using banks just to be able to store money. Another thing happens if I, as an individual, let's say I had 10 grand to loan out and I was going to find somebody who I thought was worthy of that $10,000 and would pay me back. We have a problem called asymmetrical information when it comes to people who want to borrow money and people who have money to loan out. If somebody wants to borrow my money, they have a lot of incentive to keep information from me about why they might possibly not be a good person or can't be trusted with my money. Instead, they would provide me all this information on the positive side, why I should loan them money. So when anybody asks you to loan them money, they're going to give you all the reasons why you should and why they are worthy and why you will pay them back. The fact is, they're not giving you all the information. They're giving you the information you want to know. Well, the upside to using a bank is the financial intermediary. Banks have the wherewithal, they have the tools to collect that sort of data and get the whole picture of whether somebody is creditworthy or not. And they really take the risk out of us lending money ourselves. They basically guarantee that we're going to get our money back if the bank loans it out, if you will. So the bank spreads the risk out. For you as an individual lender, they essentially do the legwork, lend out the money, and therefore decrease the potential risk of loaning out money to one individual who doesn't pay you back. All right, so let's talk about how banks come to be. This is important for a couple of different reasons. You need to understand what the balance sheet of a bank looks like as we move forward in this monetary theory, monetary policy discussion. So for those of you who are accounting majors, this is just going to be quick, easy balance sheet type stuff. For those of you who don't like accounting and who aren't accounting majors, this is as difficult as it's going to get, is what I'm about to show you. You don't need to overthink this, but you do need to understand what it takes to start up a bank, because you need to understand what banks need to invest in, which part of that is going to be the Federal Reserve Bank, which brings us back to that monetary policy discussion, or makes that link. So the first thing a bank has to do is the bank has to actually be granted the right to operate. You just can't start a bank, right? There's a process dictated by regulation and things like that. So the first thing you have to do is get what's called a charter to start a bank, and that gives you the right to A, start up a bank, but B, then also requires you to follow certain procedures when starting up a bank. So the first thing you need to do is get money, get investment. So whether that's one individual, which is highly unlikely, or a group of investors, which is much more likely, you got to have money to start any business, including a bank. So that initial investment is going to be what we would call the stockholders' equity, the shareholders' equity, the owner's equity, whatever you call it, it's the same thing. And that's going to be used to buy whatever you need in terms of capital. So that's going to be the actual building. That's going to be desks and computers and chairs and whatever, right? That stuff we need to actually produce a good or service. But part of it has to be used to buy stock in the Federal Reserve Bank. Every bank is required to buy stock in the Federal Reserve. It creates a really solid link between the bank of the banks and the banks themselves. So an important piece that really is required of every bank. Then they got to start that balance sheet, assets and liabilities. And I'm about to show you here in a minute what that's going to look like for a brand new bank, a hypothetical brand new bank. And once you've sort of done those two things, sort of set up that balance sheet, made that investment in the Fed, made any capital investment that you needed to, you're ready to start taking money from people. So when we look at a bank's balance sheet, right, in this case, in this particular exhibit, it looks like $500,000 is what these investors had to start this bank. And it looks like they spent $450,000 in building and furniture. That's the capital investment. And then they made a $50,000 investment in stock at their Federal Reserve Bank, their district Fed. I told you our district Fed was San Francisco. So every bank has to do that to buy into that system. So you can see assets are going to be that stocks and investment, the building and furniture, and the net worth, the equity is going to be that $500,000. So then we roll down, and we have now taken $1 million in checkable deposits. So we've had X number of customers come in and give us money totaling $1 million. So you can see it's a balance sheet, it has to balance, right? So you can see that on the asset side, that $1 million is represented by the physical cash that was deposited. Now, you owe somebody that $1 million if they walk in looking for it. So it is also a liability for you as a bank when people make deposits into the bank. And so on the liability side, we have checkable deposits of $1 million. It's essentially money you owe back to somebody. It's kind of like an accounts payable that you owe to somebody if they come looking for that money. Now, for a bank, they can then take this cash and they can begin to make money with it, right? That's the whole idea. So let's talk about reserves. I touched on this a little bit in Tuesday's lecture. Reserves are what is required to be kept by the bank by law. So the Fed, the Federal Reserve Bank, decides what is required by the banks to be kept in the actual vault, right? Reserve accounts are the accounts that actually hold those required amounts of money that the Fed has dictated, but that the bank has to hold on to. And I told you that the Fed requires that banks keep 0% of your checkable deposits and 2% of your savings. So that's all we're talking about here. We're talking about really that 2% of your savings is going to be what would be a required reserve by the banks. It's what they're required to have on reserve at the bank. The money kept at the bank is its reserve. That's the terminology for it. It's reserve. So here I'm just walking you through some terminology. So your required reserves represent the actual dollars that you have in your bank, okay, that you are required to keep at your bank. Your required reserve ratio is the percentage. So that 2% is your required reserve ratio. The required reserve is how many dollars that 2% represents. I hope that makes sense. So that 2% of savings deposits, if you calculate that, there's a dollar amount. A dollar amount is your required reserves. The percentage is your required reserve ratio. So those are kind of the same thing. One's the percentage, one's the actual dollar represented by the percentage, okay? So if I give you dollar amount, and I say, these are the checkable deposits, the savings deposits, whatever, and I say, here's the required reserve ratio, what are the required reserves? You should be able to tell me, because you would just apply that percentage to whatever the actual money that was deposited would be, and then you would be able to tell me what was the required reserves. I hope that makes sense. This should be pretty easy, okay? Excess reserves is an interesting concept, because excess reserves it's an important thing to know, because it represents the money that's sitting in a bank that is above and beyond what is required for the bank to have on reserve. So for example, if we take 2% of savings and we come up with $1 million, $1 million is our required reserves. So what we're required to keep, it's 2% of savings, is that $1 million. If we have $1.5 million actually in our bank, our excess reserve is that $500,000 difference between what we have and what we're required to have. Excess reserves is money the bank is not required to keep on hand, but has on hand. And it creates a little bit of a dilemma for a bank to have excess reserves. Having excess reserves might be important because it might help you with the day-to-day operations of your bank. People will come in looking for money. People are going to go to ATM machines and take money out. So to some extent, excess reserves create sort of that working cash flow for you for your day-to-day operations. But also on the flip side, that's money you could be loaning out and making money on. So excess reserves are sort of this double-edged sword for banks. They need to have some, but they don't want to keep very much because they're losing money by keeping those excess reserves in the bank and not loaning them out. I hope that makes sense. And I think this next slide is actually going to say exactly what I just alluded to, which is liquidity. Liquidity is about accessing cash. Being liquid is about having access to cash. And profitability obviously speaks to banks making profit, making money. Really, the only money they make is by loaning money out. And so banks, here it says, banks will hold excess reserves to deal with day-to-day withdrawals on account. You know, banks need a certain amount of cash on hand to do those day-to-day. Now, I can tell you every single bank keeps track of patterns of withdrawals. We know that, you know, on Fridays, which is the day people typically get paid, they're going to need to have more cash on hand. They're probably going to need to have more excess reserves on Fridays than other days of the week. Things like first of the month, when people would get certain government checks, they're going to want to have extra excess reserves on hand just to deal with the day-to-day operations. Now, on any random Tuesday in the middle of the month, you probably don't need as much excess reserve as you might other days, okay? Liquidity, ease in which an asset can be converted into cash. Cash can be converted into cash, right? Checkable deposits can be converted into cash. So liquidity, real estate, not very liquid, right? You have to sell it before you got the money out. So in the case of banks, liquidity and profitability, you don't get both, right? So there's sort of opposing objectives. Liquid assets don't earn profit. They just sit there idle. And if nobody comes and gets that cash out, you've kept it for nothing if you're a bank, right? So let's move into some other tools that banks might use to deal with this issue, okay? What happens if a bank has a run on money. They didn't keep enough excess reserves on hand, right, to deal with it, and they start eating into their required. That's a problem. You are required to keep that cash on hand. You can't start giving that away. That's going to create a problem for you. It's not legal, right? And so we've created a system, the Fed has created a system in which banks can loan each other money, and banks can borrow money from the Federal Reserve Bank. And that gives banks some flexibility to borrow money if they didn't keep enough excess reserve on hand. So it's like an emergency fund for banks, okay? So the federal funds market, this is just a definition for you right now. It's reserve money held on account at the Fed that provides for overnight lending and borrowing of reserves among banks. So it allows banks to borrow from one another. Banks have extra money to loan other banks. They can essentially hold it on account at the Fed, and other banks can come in and borrow it, sometimes literally for one night. If they had a run on cash for some reason that was unexpected, and they got down to just the required reserves and they didn't have any money left, they need to go borrow money. Who do they borrow money from? Other banks or the Fed, okay? So the federal funds market is that market that allows banks to get that emergency cash, if you will. Okay, so let's talk about how the banking system creates money. This is very confusing, okay, because it is this very, when I say creates money, we're not talking about actual money. We're not talking about dollars that were printed at the Treasury. We're not talking about actual money. It's really more the illusion of money. It's pretty scary once we go through it and you understand what's happening. You understand that we have a banking system that is really is built on imaginary money. So just bear with me, and I'm going to try my best to walk you through this in the way that it makes the most sense. I believe you do have a homework assignment that makes you go through these rounds. You're going to want to refer back to this slide, and I believe the following slide, in order to help you go through that, okay? It's a little complicated. It's a little time consuming. You can do it, okay? So how is this money created in the banking system? Well, money has to first be injected into the banking system. How does new money find its way into the bank? Again, it can't fall from the sky, right? It doesn't just get like printed and like it's just, you have to come up with a sensible way to inject money into the economy. And the Federal Reserve Bank is really the one who does this best, injects new money. The government can do it too. Government can inject new money by increasing spending, by sending UNI checks, whatever. But the Federal Reserve Bank can do it too. And this is where we first start to talk about real monetary policy. And so here it says, round one, Fed buys a $1,000 US bond. This is US debt. We talked about this on Tuesday, okay? The Fed buying $1,000 worth of debt means they're buying it back. Means at some point they issued this debt, this bond, this security, this investment, and now they're buying it back. Who are they buying it back from? You, me, companies, whoever here in the US invested in those US bonds, they are now buying that bond back. We don't need to get into the specifics of bonds and how they're traded. We'll leave that to you finance folks later on down the line. We're just going to keep it simple because it's the concept that's more important than the actual dollar amounts, okay? So if the Fed buys, if I have $1,000 US bond that I bought as an investment, and the Fed buys it back from me, I then take $1,000 and deposit it in my bank, okay? So the Fed sent me $1,000, I gave them back the US bond, right? And then put that $1,000 in my account. So that's that round one. That's how the money finds its way back into the economy, is the Fed buys back my bond, gives me $1,000, and I deposit it, okay? So I've deposited, it's just sitting there. In this particular example, the reserve ratio is 10%. The reserve ratio is 10%, which means that banks are required to keep 10% of the money that's deposited. Here, we're just keeping it simple. We're not making any distinction between savings or checking or whatever. We're just keeping it simple, 10%. Banks got to keep 10%, okay? So this round two, right, is the bank keeping 10% of the $1,000 that they're required to keep of my money. That's $100. 10% of 1,000 is 100. They're required to keep it. The bank is now going to take the $900 difference. They're going to loan it out to somebody. Who are they going to loan it to? I don't know. Let's say in this case they loan it out to you, right, as part of a student loan. And so you take the $900, right, and then you deposit it into your account, okay? And then you write a check to NAU for that $900. NAU deposits that $900 in NAU's account. Let's say that's a different bank than mine. It's definitely a different account, right? Let's say it's a whole different bank. That bank gets the $900. We are now on round three. You've spent the money. You've spent the $900, right? Now we're at round three. NAU deposits $900 in their bank. Their bank keeps 10% of that $900, which is $90. And that bank now loans out $810 to somebody that comes to their bank looking for money, right? This keeps going, right? Each of these banks where this money is deposited and then loaned out and then deposited and loaned out is acting like they actually have the money. This is virtual money. This isn't actual money. That $1,000 was the only actual money. But do you see now how many loans are being made at different banks on that one deposit of $1,000 that's being spent and redeposited, spent and redeposited, and spent and redeposited, and loaned out and loaned out and loaned out and loaned out? The banks actually loan out many, many, many times that $1,000. It's not real money. It's electronic loans based on one initial deposit of $1,000. You know, this is kind of hard to wrap your brain around. It's hard for me to wrap my brain around. The important thing is for you to know that it happens and you to know how it happens, okay? And it happens because money travels electronically. Those dollars don't actually physically exist, okay? So let's keep going. Just give yourself a minute. Trust me, it took a long time for me to finally just accept the fact that this happens, right? But you can see, right? You can see that that initial $1,000 was loaned out. That $900 was the first loan made on that 1,000, right? then an additional 810 was made on that 1,000, then an additional 720 was made on that 1,000. That 900 plus the 810 plus the 720 plus, we're only on round 4. There's around 5, 6, 7, 8, 9, 10, 11, 12, until there's no money left to loan out. Until every bank has kept their 10%, and there's really essentially no more money to loan out. Those numbers get really, really, really small. So if we go down to the next slide, right, sort of shows those deposits, okay? So this round 1, that was my bank, right? I got that $1,000 from the Fed when they bought my bond back, right? And then that money got deposited into NAU's merchant trust, okay? That $900 you borrowed and sent to NAU, right? And then that 810 got loaned out from merchant's trust to loan out to somebody to start a business, right? And so then they took that 810, that new business owner, and they deposited that 810 at their Fidelity Bank. And this just kept going and going, round 4, round 5, round 6, round 7, okay? By the time this was all done, right? The amount of money that got deposited from that 1,000, the amount of money that got deposited was $10,000. There's only $1,000, right? But these virtual transactions turn that 1,000 into 10,000. 10% of that was required reserves, so banks had to keep on hand. So that's 1,000. And the increase in money that got loaned out was that other 90% of the 10,000 that was created in the banking system. You can see that the 9 plus the 1 is going to equal the 10, or the 10 minus the 1 equals the 9. That's sort of your double check that you got all your rounds correct, if you will. This is what your homework's going to look like. This is the slide you're going to want to come back to for your homework, okay? Now, there's an easier way to do this. Your homework is going to require you to do this one time. I will never require you to do this on an exam. It doesn't make sense for me. Doesn't make sense for you because you'll never use this again, right? But I need you to know about the money creation process. So we're going to do another multiplier, okay? This is an equation you are going to need for your exam, so make sure that you jot it down or come back to it or whatever. And this is something called, instead of the simple spending multiplier, it's called simple money multiplier. And how you come up with this multiplier is you take 1 and you divide it by your reserve ratio. Your reserve ratio, the percentage that banks are required by law to keep of your money that's been deposited. So in this case, it was 10%. In this example that we just went through, it was 10%, or 0.1. If we took 1 and we divided it by 0.1, we would get a multiplier of 10. So if we go back up here, right, our multiplier is 10. You take that $1,000 initial injection into the banking system, and you multiply it by 10, and you get a $10,000 increase in checkable deposits. That's exactly what we came up with. Had we done all those rounds and added them up, right, we would have come up with that 10,000. So it's coming up with the same number by calculating it using a multiplier, which is always preferred to doing this, which is insane, right? And so how do we figure out what the change in the money supply is? I just showed you. You take that simple money multiplier, in this case it was 10, and you multiply it by a change in fresh reserves. Fresh money coming into the banking system. Fresh reserves. Reserves is money in the bank, right? These are fresh reserves. They're not required reserves, right? It's just reserves is what we call money that's sitting in a bank, okay? When we talk about this multiplication effect that happens in our banking system, we call it money expansion. We're kind of creating money, but I think when you say create, sometimes people imagine you're printing money. We're not printing money here. We're creating this illusion if you will, of money in the system. Okay, we're expanding money that doesn't really exist. That $1,000 existed. None of that other money actually exists. Okay, just exists in computers. So when we use this multiplier, we have to make some assumptions about the money to make this multiplier a good predictor. The first assumption we have to make is that banks aren't keeping any of the money that's deposited as excess reserves, that they're loaning out every penny that they can of the money that's being deposited, these fresh reserves. It's a decent assumption, but we know they are going to keep some excess. They really have to. We don't know how much. But this multiplier assumes they keep no excess reserves. Okay. It also assumes that when you borrowed that first $900 that you said you were going to pay NAU tuition with, makes the assumption that you actually used all 900 to pay tuition, or at least to pay some expense, that you spent all 900 of that. It's a pretty decent assumption that you spent it all. Why would people borrow money if they didn't intend to spend it, right? It wouldn't really make sense. It's a decent assumption. And it also makes the assumption that you didn't, and this sort of goes along with the last point, that you don't just want to keep cash in your pocket. That you didn't borrow that $900, give 800 to NAU, and put 100 just kind of sitting idle in your pocket. Again, I think that's a pretty decent. I think it's a pretty decent assumption that you're going to spend money that you borrow. I think it's the first one, the one about the banks not letting any excess reserves sit unused. I think that's probably the more unrealistic of the three assumptions, but they are assumptions that we have to make, okay? On the flip side of money expansion is money contraction, is taking money out of the banking system. Money multiplies out of the banking system the same way it multiplies into the banking system. And so if the Fed wanted to take money out of the system, they would sell me a bond. They would sell me US debt, which means I would then write the Fed a check for $1,000 or do a transfer for $1,000. And then that $1,000 would go out of my bank to the Fed, and it would no longer be available in our system, in our banking system. It would no longer exist in the banking system. And that same multiplier that expanded the money can also contract the supply of money in our banking system. Okay? Sometimes money supply has to be contracted. We'll get into that a little bit more on Tuesday. But now I'm just kind of showing you how it happens, kind of behind the scenes, okay? Okay, money expansion happens more often than contraction, I would say, for the most part, okay? All right, so now we're going into some more definition stuff. The Fed's tools for monetary control, tools essentially for monetary policy. Well, what does the Fed do to control money and therefore control the economy? This first one is one of the most important takeaways from today's lecture. And it is that buying and selling of those US bonds simply as a tool to manipulate the money supply and manipulate the economy. This is big. This is a big one, okay? And we're going to talk a lot about this buying and selling of this US debt, US bonds, US securities, whatever terminology you want to use. We call that open market operations. It is a big tool in monetary policy. It's a huge takeaway, okay? The federal funds rate, we talked about the federal funds, right? And how banks could borrow money, if you will, from one another. The federal funds rate is the interest rates that banks can charge each other to borrow money, okay? The discount rate is the rate the Fed charges if a bank comes straight to the Fed and wants to borrow money. So banks can borrow money from each other. They can borrow money from the Fed. The Fed gets to manipulate those rates. If it's inexpensive for banks to borrow money from each other or from the Fed, it gives banks an incentive not to hold on to excess reserves, to go ahead and loan those out. Because if they do need cash, it's cheap to borrow, right? And so it is a tool for manipulation by the Fed to change or alter the federal funds rate or the discount rate, right? The Fed is in charge of really most, if not all, interest rates to some extent, okay? Another big tool, big tool is reserve requirements, reserve ratios. The Fed's the one that gets to say how much of your money a bank needs to hold on to. The less money that a bank is required to keep as required reserves, the more money that gets circulated and multiplied through the system, right? So the fact that banks don't have to hold on to much of your money probably isn't good for you, but it's pretty decent for the economy because it gets all money moving. It doesn't let money sit idle. Money that sits idle doesn't buy anything, doesn't become income for anybody, and doesn't get multiplied through a system. It is those really low reserve requirements that really allow money efficiently to circulate through our system. I can tell you most countries have very low reserve requirements in their banking system. Very low. I think one of the highest I've seen, and I probably shouldn't even say it out loud, but I want to say is in China. And I want to say it's somewhere in the 8 to 10% range. Now, that's not current data. I need to double check that. But this is just to give you an idea that most banking systems operate in a similar way because idle money isn't good for an economy, okay? So they can raise or lower reserve requirements. They can reduce the banking system's ability to create that imaginary money, or they can increase the banking system's ability to create that money, okay? We've sort of maxed out on our capability to create money. So really the only way that the Fed could really move, because remember we're at 0% and 2%, 0% for checkable and 2% for savings, really the only way they could move was to increase reserve requirements, which would reduce the banking system's ability to create money. That would be for an economy that's overheating. They'd want to do that. We do not have an economy that's overheating, clearly, right now. Coping with financial crises, it is a job of the Fed to do that. They do come clutch a lot when it comes to trying to get us out of crises. They did it back in 2008, 2009 with the Obama stimulus package. Recently, the Fed decreased interest rates, sort of when they saw the economy softening. They do create probably a more effective system for dealing with crises because there isn't as much government bureaucratic stuff going on in the Fed than there is in the government. So monetary policy is many times more effective and quicker. It's quicker. Maybe not more effective, quicker, which in essence makes it more effective. So the Fed tries to reduce disruptions in the financial markets through the use of all sorts of different types of regulations. with subprime mortgage lending. Obviously, they didn't do that, but have corrected that, but it's kind of their job. The Fed is a money machine. Most of this actually comes from their ability to inject money into a banking system or extract money out of a banking system. So that's kind of figuratively creating money. It's not actual money, but they also are the ones many times that make requests to the Treasury Department to actually, oh, looks like I have something on chat here. Let's see, that I'm interested in. China's current reserve ratio for large banks is 13 and for smaller banks is 11. Thank you, Sean, for the update. That has gone up. That has gone up. And that could be because of the economic situation. That wouldn't surprise me at all, that China's afraid that it's a conservative approach, right? That if people go looking for their money, trying to cash out of banks, the banks won't have the money. And so perhaps they've increased those reserve ratios for that reason. That's a little counterproductive, right? You want to get money moving through an economy, but it's a conservative approach. Then the Fed also makes requests for physical printed dollars. Now, adding lots of physical printed dollars into an economy causes inflation. It's a problem. So the Fed doesn't really print money to try and deal with financial crises. That wouldn't be a good tool. It would just create lots of inflation. So I think that is it for this PowerPoint.